Welcome to the Tuesday edition of the Not Your Average Investor Show, where today we are going to be talking about how to invest in rental income properties through your retirement funds. Right now, we are officially live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, the man that we call GC because of his genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us today is the star of the show. He is the Vice President of NuView Trust. That is a third-party administrator for self-directed IRAs and retirement plans. He's been there for 15 years plus. If you look up Jason, he has appeared on 1 million podcasts. I looked him up online. He is all over the place. He is an expert in how you do this. He's joining us for the second time on the Not Your Average Investor Show. Jason DeBono, welcome, Jason.
Hey guys, good to be here. Love talking shop and love talking shop with Greg. We go back a long time, and Pablo, good to see you again as well.
Likewise, man. Likewise. And happy to have our Not Your Average Investor Show family in the house. If you are looking to know about how to invest in rental income properties, you're in the right place. If you're looking for advice on the best property management practices in Jacksonville, you're in the right place. If you're a real estate professional looking for an edge, looking for extra opportunities for you and your clients to benefit from, you're in the right place. The next step is to go to chatwithjwb.com. And right now, Jason, you didn't see this before, but we got a little tradition. It's called the roll call. You ready, buddy?
I'm ready. Nervous,
all right.
Ready.
Drew Barnhill, good afternoon, all. John Henning, good afternoon, all. Bill Shields, buenas tardes, maestra. Bill Shields and I put a little bet on the ponies this weekend in Vegas, and we broke even. Anthony Dida, hello, everybody. Leo, good morning from California. Nadeem Shah, good morning, good afternoon. He's coming from the West Coast, too. Bill Shields translated to good afternoon, horse masters. Thank you, Bill Shields. I'm going to explain that joke for sure. Jen Filson saying, hey, juice cleanse. Welcome. Jen's from the Monterey Peninsula. She knows all about juice cleanses. Dean Curry, good afternoon from Columbus, Ohio. Good afternoon. Good to have you back, Dean. Hetty Pritchard. Hi, everybody. Hetty, it's good to have you back as well. I recognize your name. And who else we got? All right. James Taylor coming in from Minnesota. James, we got a little secret here that when you first pop in, we want everybody contributing. We love doing this roll call, but when you first show up, it only defaults so that we are the ones that see you typing in the chat. So you got to change that button from panelists to panelists and attendees, and everybody can see everything you're saying. And Hetty, you got to do that too. And that way everybody can chime in whenever you do something. You can make a new friend. James is a quick study. He's got it. Second is we want you asking questions, right? Jason is going to be talking about his area of expertise. If you have any questions that are specific to yourself, pop open the Q&A box and put it there. That's the best place to put it for me, so that while the chat's going, I don't go cross-eyed keeping track of it. And we'll get it answered by Jason and Greg, and maybe they'll have a lively exchange. Greg Stone coming in. Howdy, Greg Stone. Good to have you, my friend. And without further ado, oh, one more. Joel Reese. Aloha, Joel from Hawaii. All right. Aloha, Joel. All right. Let me catch my breath. Without further ado, Jason, tell us about what is business like right now, man? Is self-directed IRA investing as crazy as the appreciation in the rental income property environment? Like, are there a lot of things that are happening across, or are rental properties kind of like this one outlier?
Oh, I mean, I think I think you hit it. The word crazy is always a good one in times like this. You know, I think people are trying to figure out what to go do, you know, and in our world, it's no different. As a custodian, we're agnostic to what people buy, but people come to us with all kinds of crazy ideas. And a lot of it is square down the middle of the plate, like real estate. And a lot of it is some unique and esoteric type investments. But yeah, right now, I mean, we're incredibly busy. We're fortunate in a lot of ways. But I think one of the challenges that we're seeing right now is a lot of our customers. We have a lot of people that are setting up accounts, and they're all, you know, coming to us with the same problem, which is we can't get a property. We have an IRA, we want to buy real estate with it. We've put 12 offers in, and we keep getting outbid. So, I think what happens, unfortunately, in any good investment market is, one problem creates another one, right? It's a good problem to have with things going up fast and shortened inventory and appreciation. But the other side of that is a lot of investors that are either priced out of the market, their accounts only got so much money in it, or they just can't seem to get their hands on a property. So those seem to be probably the two biggest things we're hearing right now.
Jason, what you're talking about is what we talk a lot about on the show, right? Lack of inventory and how difficult it really is out there to be taking advantage of this asset class. And I want to explore that a little bit more down the road. But I know there's a lot of folks that are on the call right now that are still wondering what it really means to be able to buy a property in your retirement account. And they may have been told by friends or family members or others that it's not possible or that it's illegal to do that. Can we start from square one and really recognize those folks who are just maybe first time on the show here and just explain the nuts and bolts of how your company helps those invest in real estate through their retirement accounts and what are maybe some of the important things that they need to pay attention to when they go down that?
Yeah, happy to. And I think it's something that is often overlooked is kind of, there's a lot of people that just don't even know this is possible. And forgive me for maybe stepping over, that group of people on the call today. The idea of buying real estate in an IRA is not a new concept. It's not a new opportunity. In fact, it's been permissible in retirement accounts since IRAs were first created. The challenge hasn't been whether or not the IRS lets you do it. It's finding a custodian willing to hold it. So, it's kind of like having a favorite type of food that's somewhat unique, and good luck finding it at a restaurant, right? And the restaurants don't serve it because they choose not to. And the reason that Schwab's and Fidelity's and TD's, all great companies, but they're in the business of electronic public securities, moving in and out of accounts. They're not in the business of a customer taking retirement money and, wanting to go buy a house in Jacksonville, right? There's closings and there's paperwork that moves and there's payments and there's rental income. And, it just doesn't all work the same. And if you get it figured out, the property next door looks just a little different than the one next door, even though conceptually in our eyes, it's all about the same, but procedurally from a, operation standpoint, there's nuances across the board. So, self-directing in a retirement account is simply the act of taking your own retirement money and using it through a custodian that lets you buy anything the IRS permits. And really, with the exception of life insurance and collectibles or any sort of deal that, involves you or your own family members, there is no limit to what you can do. So buying real estate is a little bit more of a manual process. It does require self-direction, does require you to go find your investments or to go find people like Greg and their company that can help you through that process. But NuView as a custodian is completely passive. So we're only here to hold the account. We're here to provide all the record keeping and reporting. We're here to buy when you tell us to buy, sell when you say to sell, and do everything in between. But the act of finding your own investment and deciding what you want to buy and doing due diligence, that is the self-direction.
For me, Pablo, I got something. I saw you
go
ready there. Pablo, it's so nice. I mean, it's so nice having you in the studio, man. I almost don't remember what it's like when you're not here with me, man. We've got I got our stick down. But Jason, I just wanted to kind of get in the headspace of maybe a client who maybe has had their money in the stock market, stocks, bonds, mutual funds. It's very traditional in that sense. And then they come to a self-directed custodian like NuView, of which I'm a client of NuView as well. I love working with your team, Jason. They take care of me and my clients so well. So thank you for that. What is that client looking for? What's maybe the number one reason that people are actually thinking of doing something that is not traditional and coming to a self-directed custodian, either for rental property investing, private lending, or other types of investment?
Yeah, I mean, I think it probably could compartmentalize them in a few different ways. Clients come to us for a variety of reasons, and some is painfully obvious, and some we kind of speculate, right? We don't necessarily know. I mean, I think the first group would be people, and I'll just put, they know and understand it. And whether they're experts in real estate or not, they just know and understand real estate a lot more than they know and understand the stock market. And, I am not I've never been a stock guy personally. And I could tell you the few stocks I've bought and sold, and you'll understand why I'm not a stock guy. I'll prove it literally. But the thing about stocks for me is it's just so hard for me to understand what makes them go up and what makes them go down. It's hard for me to understand if I do something and it's a winner, how do I do it again? And I heard you guys talking about Vegas, and so I'll compare it to Vegas, one of my favorite places. Now, I don't bet on the ponies, because I'm absolutely terrible at that. And I don't know if I can say I'm good at blackjack, because I think that's every good lying gambler's, phrase is they're good, or I'm not like anyone else. But if you think about it, blackjack is a game of chance, and it's a game of odds. And the goal is to try to mirror, right, your bets against what gives you the best odds to win. But at the end of the day, there's a card that's going to be flipped that you have no idea what it is. And it can go your way and it cannot go your way. And if I ever leave the blackjack table with money, I feel good about it. And I know what gave me the highest likelihood, but I can't duplicate it, right? I could sit down at the table right next to it and give it all back. When I look at stocks, I view it the same way. I can make decisions that are going to give me a better chance. And yes, I can tell you I'm going to make more money on a blackjack table than probably 30 or 40% of the people at the table, because they just don't even understand it enough. But I understand it only to a point that it gives me a slight edge, not a big bet. When I look at real estate, not to say that you can't lose money in real estate, but once you understand real estate, and again, if I take the time and understand it more than the other 50% of the population, I have a huge advantage on being successful. And I can't translate my knowledge and experience in the stock market like I can the real estate market. So, I know I kind of danced around from an analogy standpoint, but I think the main reason people come to us up front is they just don't get the market enough to feel like they've got a chance at success. Even though they've had some success, they've left the table with a little bit of money. It's gone down, it's gone up. But being able to duplicate their efforts in real estate, if I have a bad deal in real estate, chances are I'm not going to do that type of deal again, right? Or chances are I miss something. Whereas if I look at all the wins I've had in real estate, if I follow the basic fundamentals, chances are 95% of the time I'm going to get it right. And when I can couple education and knowledge with outcome, then that's where I want to put my.
Makes a lot of sense to me. Just for the record, we were talking about betting ponies because last week on this show, Zach Correa was our guest. He had a horse that he owns running in Del Mar on Sunday. And I happened to be in Vegas for a trade show, and we coordinated betting on the horse, which won third. So we made our money back. So Bill Correa. so Bill and I did okay. We know nothing about horses, but we got a couple of really good questions for you, Jason, right now. We got Harry Subramonian. I hope I pronounced that correctly, Harry. Let me know if that's accurate. And Harry puts, can money be moved from current job 401k to an STIRA, or only when you switch jobs, an old 401k can be moved to STIRA?
Yeah, unfortunately, and I'll say, unfortunately, but as a general rule, if your money is tied up in a current 401k plan, you're under their mercy as to whether or not you can roll it over to a self-directed IRA. So think of us like a catcher's mitt. We'll catch anything that can be thrown at us, but you've got to get the validation from your current employer. And I won't tell you no, but I'll tell you, don't set your expectations much higher than no. And the reason is you're covered under a group plan, and group plans follow group rules, and group rules are set at the employer level. And the whole reason they want you in the plan is an employee retention tool. And so they generally don't have any way of you getting out of it unless you're no longer an employee. So unfortunately, I don't want to tell you to go and quit your job. You'll have to come to that, device in your own manner. But if you do want to get money out, as a general rule, you've got to be severed from employment.
There you go. All right. We got another question here. Tommy Thurman asks, can you co-own a rental property with your 401k? And if so, can you get a traditional mortgage for your portion versus a non-recourse? Example, you pay 50% cash from 401k and 50% your personal mortgage. As a co-owner, are you still excluded from using the property?
Well, first of all, thank you for that question. That is someone that's either done some research and due diligence on their own end, or certainly been listening to this podcast for quite some time. That's a pretty advanced question. I share that just so that if the words that he used don't make a lot of sense, my answer probably won't make a lot of sense either, and it's okay. This is, we're sprinting at this point into self-direction, and I'm happy to do it, but we'll slow down a bit through the answer to try to make it make sense. When you buy real estate with a retirement account, the only way that you can get leverage is if you leverage it without personally guaranteeing the loan. So if you think about a house that you buy personally, you go to a bank and you tell the bank, I'm going to give you 50 grand down, and you're going to give me 250 grand to buy this $300,000 house. And in the event that I don't pay you, you can come after me personally for any money that you don't get through foreclosure. In a non-recourse loan, in an IRA, because the way that IRAs work, you cannot personally guarantee the debt for your IRA. The IRS says if your IRA doesn't pay the loan, only your IRA can be the one that deals with the bank. The bank can't come after you personally. So most people don't realize this, but you cannot margin trade stocks in an IRA, because when you buy stocks on margin, it's just like buying a piece of real estate with a loan. You make a personal pledge to repay the debt. If you can't make money on the stocks and you have a capital or a margin call, in an IRA, you cannot margin because there is no personal guarantee. They can't come after you to cover the margin calls. So with all of that said, the question kind of gets into another advanced topic, which is, can you as an individual buy an investment alongside your IRA? And I'll answer that question first, which is yes. So to give an example, my IRA could take $100,000 and I could take $100,000 and I could go to Greg and say, Greg, go find me a Jacksonville rental for 200 grand. And let's assume that's what it cost, was 200 grand. He would in theory, right, sell half to me personally, and it would be titled that way, and half to my IRA. And then as rental payments came in, half would go to my IRA, half would go to me personally. As expenses were due, half would be paid by me and half would be paid by the IRA. And the IRS says, as long as you keep everything split on title and pro rata for dollars in, dollars out, it's perfectly permissible. The question that was asked that goes even a step further is that if my IRA pays for half the property, can I personally buy half the property and get a loan? So I'm going to use that same example that I used with Greg. $200,000 house, $100,000 for my IRA buys 50%. The $100,000 that I want to buy personally, I'm going to put $20,000 down and borrow 80. There's a theoretical and a practical issue here. In theory, yes, you can do that, because as long as it's clearly titled to you and clearly titled to your IRA, in theory. As a practical matter, the problem I'm going to have is getting a non-recourse loan or getting a loan. If I go to a bank and ask them to loan me $80,000, right, so I can buy half this property, the bank is only going to do it if I give them the whole property as collateral. And the IRS says you cannot give up your IRA's free and clear ownership as collateral for your personal loan inside an IRA transaction. So it's one of those theory versus practical. If you could find someone that would actually write you a loan secured by only half of the property, you could do it. So your IRA would own 50% free and clear, and then you would own 50% subject to a mortgage, which encompasses 50% of the property. I'd love to know if you could do it. I'd love to see what the paperwork looks like, but I've never seen anyone do it in my 16 years, but maybe today's the day.
Yeah. And I'll just piggyback on that. We've never seen that as well, right? It's, if you're going to be able to get a loan with a purchase in your retirement account, it would be that non-recourse financing is the only way that we've seen it pop. And definitely I've never seen something collateralized by half a house too. So I don't know who does that. I just wanted to add one more thing too. We've been talking about buying rental properties and working with maybe yourself personally and your retirement account, or maybe even putting multiple retirement accounts together to be able to do an investment in rental properties. You can also do this with private lending. I was just going to share a personal example of how I manage my own family's finances. So right now, I do private lending for other investors as well. So I lend out my retirement account dollars to other investors, mainly because I can't lend it to JWB because it's one of those disqualified transactions. But what I do is I actually take the retirement accounts of my wife, my retirement accounts, my kids even have retirement accounts that are accounts with NuView as well. And we combine all of those because my kids' accounts are really small amounts. I'm able to take my retirement accounts, which is a little bit more substantial, my wife's, and add those, or actually not add, actually partner with my kids' retirement accounts to go ahead and do one larger private lending investment to be able to get smaller dollar amounts together. So you can work together with multiple retirement accounts or with yourself outside of your retirement account. You have to do it the right way. And of course, you're not going to be able to do the conventionally financed option that we were thinking about with the original question.
Well, and the strategies to self-direction, are so vast. And I love that example, Greg, because it's something that, people kind of hear and probably think, man, if I could ever do that, that would be great. And, really all you've done is simply taken advantage of the ability to put money away for multiple family members, in this case, spouse and kids. And then in turn say, how do I use this money most effectively in an investment, opportunity. And what do those look like? And the beauty is, that's pretty straightforward. It's actually not a terribly advanced topic. Getting into borrowing money and non-recourse loans and half a house being collateralized. We can really make this sound like it's really hard. But what Greg's talking about is really simple. In fact, you could take your own retirement money. If you've got kids, you could start an ESA or HSA, depending on your health situation. If they can work for you, you could start them a Roth. There's so many things. And these are, I would say kind of 101 level tactics. So I appreciate you bringing us back down from that sprint to a nice moderate jog, which is probably where we belong.
That's why you keep me around, to make sure I'm the slow one in the group.
They call him GC because he's the great clarifier. All right. So Jackie's got a question. She asks, do you offer Checkbook SDIRA?
We do. So understand that Checkbook, self-directed IRAs are two separate things that get married together. We do, as a custodian, hold LLC or single member checkbook LLCs inside IRAs. We've been doing that forever, but we don't create them. I don't know of any custodian that actually creates the LLC structure for you. You can do it yourself. You can do it through your attorney, accountant. There's some online resources. But yeah, if you have an LLC that you want your IRA to be 100% owner of so that you can get the quote unquote checkbook control, we can certainly do that. Caveat I give to everyone, same disclaimer, is just understand where the landmines are. You're not just getting behind the wheel, but you're really getting behind the wheel. And if you feel comfortable driving, go for it. But if you're getting behind the wheel and you're kind of a novice to what the rules and regulations are, I wouldn't say don't do it. I would just say pump the gas or pump the brakes for a minute and make sure that you go onto our website and review some of the collateral and content on prohibited transactions and what the rules are, just so you don't stub your toe. Because once you're officially behind the wheel, if you make a mistake, it can be hard to unwind some of those. So hopefully that gives you an answer is yes, but beware.
Speaking of novices, I have a friend who's a real novice in this. And my friend wants to know, what is a checkbook self-directed IRA?
Well, good question, Pablo, or I'm sorry, good question, Pablo's friend. Thank you for filtering that to us. A checkbook. So when we talk about, if you kind of think about the avenue of investing, most investments are held directly in an IRA. So when we say self-directed IRA, or really any IRA, it means that the IRA owns the investments. So you have an IRA, Schwab custodies it, and you own 1,000 shares of Microsoft inside it. Straightforward, no LLC, no entity, no checkbook control. You simply hold it. Greg has an IRA at NuView. He loans money out at 12%, right? That loan is held in his IRA. That's just a standard self-directed IRA. What checkbook control is it says we're going to insert an entity between the investment and the account. And the reason or reasons people do it is, and there's a variety, some make sense, some don't, but the reason that people do it is because they want to have what's called checkbook control. They want to be able to make the transactions themselves. So they want to be able to go buy the real estate and actually write the checks. They don't want to have to go to NuView and ask us to write the checks on their behalf. And so in doing so, they're creating an LLC of some kind, and then they're directing the IRA to fund the LLC. And then the LLC buys investments, as opposed to directing the IRA to buy the investments directly. And the only thing that I caution in that, and we have thousands of them on our platform, I think it's a great strategy. But like I tell everyone, because I just simply don't know how much knowledge these people have, it's just to make sure they understand the rules. Because when you're out writing checks and buying properties and paying expenses, you don't want to stub your toe. And I want all our clients to stay above water, and I want to keep all of our clients to stay out of any sort of potential trouble with the IRS. So as long as you follow those basic guidelines and know the rules, and yeah, go for it. The LLC can be a great structure.
All right. That was we're getting some deep education in the matter. I like it a lot. Louis Goins from Tampa, Florida. Welcome back, Louis. Asks, what are the tax consequences if I need to finance a property along with using my IRA? I read something about having to pay 37% tax on the income because of the loan.
Yeah. So unfortunately, sometimes the result of making money is paying tax, right? So I learned at a very young age from my dad. He said, if you want to make money, don't be scared to pay taxes. That said, we have to be smart enough about the tax code to figure out how do we avoid or minimize or mitigate as much of the tax liability as we can. So as a general rule in an IRA, one of its, natural functions and best qualities or characteristics is that it's tax-free. So, your transactions are exempt from tax. You either pay when you put the money in or you pay when you take it out. But if I have a Roth IRA and I put $100,000 into a house and sell it for 200, I don't owe any tax. And then I take the 200 and buy a house and sell it for 400, I don't owe any tax. So it's a beautiful thing. If I want to go leverage beyond the value of my existing IRA through a non-recourse loan, then I'm going to subject the leverage portion to tax. And I want to make sure, everybody's paying close attention to this, because this is critical. And when you read stuff on the internet, sometimes it can portray it to be worse than it is. But I'm going to give you an example of how this tax works. So it's called unrelated debt financed income tax, UDFI. It falls under the same code as UBIT, unrelated business income tax. So it's most commonly called UBIT, even though it actually is not UBIT, it's UDFI because you financed a property. But UBIT, for the sake of simplicity, and UDFI just doesn't have as good of a ring to it. So UBIT it is for the sake of discussion. But if I take $100,000 property and I go out, or I'm sorry, let me just take an example of a $200,000 property. So I'm going to call Greg. Greg's got a $200,000 property for me, and I'm going to go buy it with my IRA. If I pay cash for it, $200,000 in my IRA owns it free and clear and is not subject to UBIT, because I didn't leverage it. I rent that property out for a year. Let's say I, make a little bit of money, whatever the numbers are, and I sell it 2 years later for 400. That's $400,000 goes back into my IRA completely tax-free. 200 of that's profit. 200 of that is principal, right? But I just made $200,000 tax-free. That is the beauty of an IRA. Now let's use that same example. I call Greg. Greg has a property. It's 200 grand, and I only have 100 grand in my IRA. But I want to do the deal. It's where my money is. I don't want it in the stock market. You get what we've already talked about. I take that $100,000 and I put it down, and I take $100,000 from a non-recourse lender, has to be non-recourse to my IRA. And I now own that $200,000 piece of real estate in my IRA, right? Then there's a mortgage payment that I have to make, and I pay that mortgage payment out of the rent. So $900 mortgage payment. Hopefully I'm renting it every month for $1,000, right? But I'm breaking even. At the end of 2 years, I sell the property for $400,000. Since I paid $200,000 for it, I only have $200,000 of profit. So that's all the IRS is going to start with. Of that $200,000, $100,000 of that investment, right, was paid for out of the IRA, or 50%. So 50% of that profit goes right back to my IRA tax-free. The other 50%, or $100,000, the IRS says you borrowed money, you went outside the IRA to earn this profit. So for that little piece of the profit, we're going to tax you. Even if it is 37%, and there are some ways to mitigate it, but let's call it 37%, you're going to pay $37,000. So what does that mean? It means that you bought a property you put 100 of your own money in, you basically took out 200, you got to pay the bank back, right? 100 of that. So the net proceeds back to your IRA are $200,000 of profit less tax. So you pay them $37,000 off the $200,000, and you just took $100,000 from your IRA and made $163,000 after tax. So option A is I invest 200 to make 200. Option B is I invest 100 to make 167. Now ask yourself, right, is that tax scary? Well, in one case, I make 167%. In the other, I make 100%. And guess which one I made 167% in? The one I paid tax. So people tend to look at taxes, and I don't want to say they make bad decisions. And I certainly don't want to suggest that the person that asked the question was thinking about it in a negative manner. It's a fair question and a good one to ask, and I appreciate you doing so. But when you crunch the numbers on these deals, and a lot of these non-recourse deals, the tax, because it only applies to the leverage portion of the gain, actually doesn't impact your return enough to offset the power of leverage. Because without it, I couldn't have bought it. Here's where I'll take it a step further. And am I okay on time? And I guess even if I'm not, I'm just going to go.
I love it. Keep rapping, bro.
If I take the same 200, right, put it in for 200, buy it for 200, or sorry, buy 200, make 400. What if I instead bought two with leverage? And now I say, Greg, I don't want $200,000 property. I'll buy two $200,000 properties. I leverage them both. Results are the same. I make $167,000 profit plus my original 100 in each account. And now I have an account that has 200 plus 335,000. I've got about 550 grand off of my 200 investment after tax versus 400 grand off of my $200,000 investment. I could even take it a step further to say that now that I own two properties, I'm diversified. So if one property goes up 200%, one only goes up 50%, right? My average gain is around 110, 20% combined. Whereas if I happen to pick the one that only made 20%, not 100%, right? I have no diversity in my investment. So obviously, I love having this discussion because I think it's so powerful. And I don't think you should always consider taking on leverage because I think there's a lot of benefits to buying cash. But I also think that leverage in an IRA gets such a bad name because of tax, but no one really stops to go, wait a minute, my purchasing power offsets the tax liability in almost all scenarios. That said, I am not your accountant and I certainly won't pretend to be. So make sure that you're crunching the numbers yourself, but hopefully at a high level, that gave you some insight into how taxes aren't scary, right? Greg, you know, one of the first presentations I used to always give, and Greg and I have known each other almost 15 years, I would start by asking, how many people in the room like to make money, right? Everybody would raise their hand, you know, and I'd say, how many people like to pay taxes? And nobody would raise their hand. And I'd say, well, then you're a liar because you can't like to make money and not like to pay taxes. They just go hand in hand. And the sooner you accept it as reality, the better off you'll be.
I love this. This was really great. Of course, I'm familiar with the concepts that you're teaching here, but putting real numbers to this is really helpful for folks. There were a lot of numbers there, but so I'm going to kind of synthesize what I know and what I heard here. People really are like, when they hear tax or they hear about a benefit they may not get in their retirement accounts, they tend to think that it totally should dissuade them from thinking about investing in their retirement accounts in something like rental properties. When we're talking about it here, we're talking about a specific tax that you may incur if you take leverage on your purchase in a retirement account. Another thing that comes to mind that I hear often is people will say, well, Greg, why would I buy properties in my retirement account if I can't take advantage of depreciation on the asset? And they say, well, you know, I don't get that tax write-off. Why does it make sense to buy properties in the retirement account? And I share a similar message, which is, let's change the perspective here, right? The reason why you want a tax write-off like depreciation, which you get as a write-off when you buy it outside of your retirement account, is because you want to write off an expense against taxable income. When you buy a property in your retirement account, you are already in the zone of not having taxable income, until you need to make a distribution, depending on the type of retirement account. So you're already getting the tax savings that you were hoping to get just by getting that depreciation write-off outside of it. But people tend to think, well, geez, just because I don't get depreciation, maybe it doesn't make sense to invest in a retirement account and purchase rental properties or whatnot. So changing that perspective is something that I try to do with folks. And the same thing can be said here for UBIT. And I didn't even know the UDFI thing. I mean, I'm learning something here too. So we'll call it UBIT, but that's a cool little nugget there. The big thing here is that the same advantages that you get for buying properties in your retirement account, as far as it being tax deferred or tax free, is still that way for the money that's in your retirement account. Right? It's not like your entire purchase is somehow subject to this UBIT tax because you leverage on your retirement account. It's just the amount that you borrowed on. So the rest of the benefits that you came to buying rental properties in your retirement accounts are still there for that portion. And I really loved how you broke that down because one little thing, one trigger, tax, or maybe one benefit that they didn't get, like the depreciation, and people say, oh, geez. People also say, and I'm sure we may get some questions about this for non-recourse financing, the terms for non-recourse financing are not as advantageous as they are for buying properties outside of your retirement accounts because there's a non-recourse component to it. And people say, well, why would it make sense for me to pay a higher interest rate? And I say, well, geez, let's talk about the big picture here and going through a scenario there where you can talk about a portfolio that might have hundreds of thousands of dollars of additional gains at the end of the day because you took leverage, because you had to pay, maybe even you had to pay UBIT on it. But at the end of the day, we're keeping our minds and our financial goals focused on creating a better outcome years down the road. So appreciate that, brother. That was wonderful.
Yeah, that was really, really well explained. And it sounds, as the average person here, although I'm not your average investor, it sounds that because non-recourse investing kind of like straddles both worlds of future tax and present tax, you can get, if you don't contextualize the tenets of rental property investing to the actual situation, you're going to throw the baby out with the bathwater kind of thing. Right. So it's like, yeah, this is an extra tax. What was asked is UBIT tax, but it's an extra tax on money that you wouldn't have been able to invest with anyway. So it's like a tax on house money, and you might as well put the house money to work as well. And then if you are thinking about it based on loan terms, then you also need to take into account the fact that you're getting that benefit on the front end. So if we're talking loan terms, Tommy Thurman asks, if purchasing through our 401k, does JWB require us to use their non-recourse lender? And if so, can you share their terms?
Yes, absolutely. There's a couple non-recourse lenders that we have vetted out over the past 15 years. And I should probably start by saying there's really only a handful out there that are reputable and that actually offer a non-recourse product. So, if you're thinking you can go into your Bank of America or Truist or whatever Wells Fargo bank and ask for a non-recourse loan, they are going to look at you cross-eyed and of course, not have that product for you. So it's a really small handful. We vetted out the key players across the country, and in terms of terms, and then also in terms of actually closing the loans. And we've got those for you. If you'd like to get more information for us to actually facilitate a conversation for you, you just reach out to my team. We're happy to set up that phone call for you. The loan terms are going to be higher, as I mentioned, than your typical conventional financing. The main reason being that conventional financing has a recourse option for the lender. They can go after your credit score if you don't pay. A non-recourse lender does not have that option. So there's significant more risk, and that's why most banks are just not interested. But your interest rates are going to be about 7.75%. The loan terms are going to be a little bit different as well. Typically, you're going to look for about a 20-year term, and your down payment is going to be significantly higher. They're going to require 50% down as a down payment. So all this goes back to higher risk for the lender, and that's why they require a higher interest rate. That's why they require a higher down payment. But the cool thing is that we've partnered with these non-recourse lenders. We understand their products. They actually cater their products to JWB's inventory, because if you're a fan of the show, you know the number one threshold for investing in rental properties, in my humble opinion, is achieving positive cash flow, making sure that the assets pay for themselves. You may be saying to yourself, well, if I have a loan that's at 7.75%, I had to, it's a 20-year loan, am I still going to be able to achieve positive cash flow? And the answer is yes. That's why we've worked so well with these providers over the years. They actually have catered their products to make sure that the investments that JWB has, if you'd like to purchase one using non-recourse loan, you're still going to be break even or slightly ahead, which is really important.
Yeah, and I think it's worth noting on non-recourse loans as well. The terms at 50% down, just a lot of people go, well, that's absurd. But if you think about what the bank is really doing, the lender is saying, I will give you the money, and the only thing I can do if you stop paying me is take the property back. And if you really put that into kind of a general comparison into what it looks like with your primary residence or other investments, it's not even close to the same. The other thing is from a down payment standpoint, we don't like to put money down because we're Americans and we like to leverage every single penny we have. And we're just hardwired that way over the years, right? In an IRA, we have money. IRAs have money to put down. And so putting 50% down isn't as scary. Last bit on the tax side, and I didn't mention this, but remember I said, don't be scared to pay taxes, but avoid them if you can. Well, one of the beauties, and this is where I'd encourage you, if you're not getting educated, and I'm saying that not speaking to you, but for you to continue your education, you're obviously on this podcast because you're looking for info and you're probably scouring the internet. But one of the most useful pieces of information you will take away today, if you're thinking about taking on leverage in an IRA, is to figure out how you qualify for a solo 401k. It is a plan that most people can qualify for, although you need to kind of understand what it means. You have to derive some form of self-employed income. You very well may have to pay your accountant a few $100 a year to file some taxes, so don't be penny wise, pound foolish. But if you buy real estate with debt in a 401k plan, you do not have to pay UBIT. So let me repeat that. If you buy a piece of real estate with a 401k plan, you are not subject to UBIT tax or UDFI tax. So we have a great team here that can kind of walk you through that. We can't make you qualify, but we can help you understand what it takes to set up a 401k for your self-employed enterprise, whatever that is or may become. But man, what a difference. So, how cool would it be if I could put $100,000 down on that $200,000 property that Greg has, sell it for 400 and put all 400 right back into my 401k 100% tax-free, even with leverage. So, kind of a little bit of, I don't want to call it a loophole because I hate that term. That suggests you got to have lots of accountants with big green visors to do anything. But it's an area of the code most people just don't take the time to understand. But yeah, you can absolutely avoid the UBIT tax by doing that.
Excellent information. We're getting a lot of requests about, is this going to be shared later? Or are we going to send it to people? So just so you know, right now, if you want to watch it for the next week, you want to watch it again, you got to join us inside of our Facebook group, jwbfacebookgroup.com. I put it in the chat, but on Monday, we release it to YouTube and we release it to podcasts. It just takes us a little while to package it so that it's natively for those platforms. But if you want to listen from now till then, join us in our Facebook group, jwbfacebookgroup.com. Almost 3,000 other rental property investors in there. You'll get a ton of value from the wisdom of the audience and the community that we built. So we would love to have you in there. And if not, just look for the Not Your Average Investor Show on podcast and on YouTube, however you would like to consume it. So Cynthia Campbell puts here in the chat, great info. Any chance we can have one of those very useful Excel workbooks done, including Jason's info/examples? Sure would have been nice to have these insights 6 months ago. So Cynthia, I know that if you go to jwbinventory.com, you can download the sheets, right? But as far as, and it has the non-recourse numbers plugged in, so you can run a non-recourse loan a non-recourse investing calculation. But Greg, what do you think about that? What do you think about doing on a Thursday, going through one of these like live examples of like one half here and one half there, and do some like advanced
yeah, let's do it this Thursday. I'll put something together. It'll be rough. And the other thing is that these are the conversations we get to have during our onboarding process with all new clients. We actually have a planning component, and we take into account, are we going to be putting retirement account dollars to your rental property investing plan? So let's do it here on the show. I'll put something together. It won't be all pretty, right? We got a limited amount of time to put this together, but I'll put the nuts and bolts together based on the example that we just went over here with Jason on the Thursday show. And then I would just encourage you to have those conversations with my team as well. You're going to get much more out of it when we're looking specifically at your numbers. You're able to ask questions back and forth, because as you can imagine, this is a bit of a nuanced topic.
Yeah, exactly. So maybe 6 months ago, chatwithjwb.com would have been the move, and you would have gotten some enlightenment, right? So don't always wait for the show. You get just as good information one-on-one. Chatwithjwb.com. All right, we got 4 more questions. We got 13 minutes. You guys ready to hit this quickly?
Whew. All right.
Florencio Escano asks, what is your opinion on converting the pre-tax SDIRA to Roth SDIRA before investing it into rental properties for tax purposes?
Let me start by saying I love the Roth. I think anytime that the IRS gives us the ability to voluntarily prepay our taxes, we should absolutely consider. Let me tell you why. And that's because if I take a Roth IRA and grow it from $1 to $1 billion, as it stands today, I owe zero in tax. So what I love is upside. Things to consider, obviously the tax bracket that you're in, how much is it going to cost you? If you convert $100,000 in your IRA and you're in the 25% tax bracket, it's going to cost you $25,000 to do that. So the question to ask yourself is, would I pay $25,000 today for whatever that $100,000 becomes over however long I plan to invest it to pay no tax? If you told me I could invest it for a couple of years and maybe it's worth 150, I'd say probably not worth 25 grand today. I'll kick the can down the road. If you asked me that and I had 15 years to go buy rental properties and sell them and buy them and sell them and buy them and sell them and flip them and buy them and sell them, and I could turn that 100 grand into $1 million plus, and I only had to pay $25,000 tax today for that, right? I wouldn't even think twice. I'd write the $25,000 check. So it really is a personal situation. How much money are you willing to write a check for the right to grow money tax-free?
I love that. I actually just lived out this example earlier this past year. I made the decision to pay the taxes on some of my traditional IRA money so that it could turn into Roth IRA money. And it was exactly for that example, or exactly for that reason that Jason just outlined, right? I looked at my abilities and the investment I was considering, and I wanted to make sure that I could put as much in my Roth IRA today, because I'm expecting to have significantly higher returns in my Roth long term. And when you think about growth that is unhindered, not hindered by taxes, that is like the best way to invest, right? People discount how important this is. So yeah, so I made the decision. I'm in a higher tax bracket now, but I still made the decision to pay that tax today, to convert it from a traditional IRA, to put it into a Roth. And the main reason is because I'm really confident in my ability to generate significant returns, and I have a long way to go, right? I'm 38 years old, so I have a long runway, and I expect significant growth that will be unhindered. I don't know if that's a word. Unhindered? I don't think that's
It is
a word.
now. Say it with confidence.
You know what? Unhindered tax growth. There we go. Write that down.
Greg's vocabulary is officially unhindered. All right. Hetty Pritchard asks, how much does it cost to create/maintain a self-directed IRA? And what are fees associated with depositing monthly rent checks and withdrawing expense payments?
Yeah, so setting up an account with us, I'll give you general terms. You'll find it may move $100 in either direction, but it's not enough to matter in the grand scheme of it. We charge a $95 fee to buy the property. We charge a $295 fee to hold the property annually, regardless of how much it costs. And then we charge $95 to sell it. So your annual fee with us is $295 for that property. There's no charge for any income into the property, and there's no charge for any expense payment as long as you make the payment through our online bill pay system. Mail us in a paper request and we'll charge you $5. Otherwise, it's free. So your only cost to us is $295.
I'll just jump in and say that I have worked with all of the providers out there, at least the most well-known custodians out there. In my 15 years of investing with my retirement accounts, and I made the choice to go to NuView for a reason. And when I thought about the fees across the board, they're roughly all the same. There's not a whole lot of difference, but there's a huge difference in customer service and care and the team that you work with. And Jason's team is second to none. They have treated myself, my family, our clients really well. So I would highly recommend, if anybody's considering to really get on the phone and talk with NuView. They're just really wonderful.
Thank you, Greg. We appreciate that.
Jason, congratulations. We're cutting you that one out and give you a little testimonial for the website, man. That was
Perfect.
Yeah, there you go. Okay. So Louis Goins asks from, this is a follow-up from before. He says, okay, that's something I got wrong that I read misunderstood. The tax didn't seem to be limited to the gain, but rather on the income produced as well. So I guess going back to that example, you gentlemen, is that clear?
Yeah, so UBIT does apply to annual income. The reason I tend to gloss over it is because unless you have a complete cash cow, which would be a great problem to have, it's absolutely minuscule from a tax standpoint on an annual basis. So any income, less expenses, less other write-offs against that income on an annual basis are only taxed over $1,000. So if I have a non-recourse loan, I have a $800 payment and I have $1,000 coming in, I'm making $200 a month, $2,400 a year. I get the first $1,000 free. And assuming I can't write another penny off, meaning I didn't have a single other expense, I've got to pay tax on $1,400. You're talking about peanuts. So, I didn't gloss over it because it doesn't exist, but that's letting the tail wag the dog, in my opinion. And the real UBIT challenge that people are going to run into, and the real meaningful amount, is going to be when they sell the property, which is kind of where we spent the time highlighting. But hopefully that clarifies. And thank you for following up with that. I certainly didn't mean to gloss over that.
There you go. He says thanks. So I think it was good. All right. Last question from Jeffrey Bolton. Jeffrey, good to have you back. And he asks, what happens if the investment falls on value? Do losses offset other gains for the taxes?
So falling in value really doesn't matter in any asset unless you sell it and take a loss. That is the one area of an IRA you never want to take a loss. You get no benefit for it. So a loss in an IRA is a loss in an IRA. And the reason why that's okay is because wins in an IRA are wins in an IRA. So If you wanted your loss to be valuable to you, you'd have to allow them to, tax your gains so that your loss has something to offset. But seeing as how there's no upside tax, I think Greg clarified that really well earlier. If I've got no tax on the upside, they're not going to give me the benefit on the downside, depreciation, losses, that sort of thing.
We had a bunch of great questions and we ran through them. There was one question I really wanted to ask you before we got off, Jason, if you got a little bit of time. And it's the idea of how is inflation affecting what's happening right now for investing in IRAs? Like, how are you thinking about the inflation that's coming and how do you see clients kind of like considering it right now?
Well, inflation is scary. I mean, for those that don't understand what it is, I'd encourage you to spend some time on the internet, really trying to research credible sources. Inflation, when it runs rampant, can cause major problems. And I don't know, where each of you guys sit in terms of your professional careers and what you do or your occupations, but almost every employer right now is feeling it, right? You ever go to a restaurant and they're closing earlier, the service has gotten slower. Well, what happens when these types of things and you have all this supply chain issues, right? We have it coupled with employment and labor issues. It's never a good thing. Now, I'm not here to be doom and gloom, but I am here to help people understand that if this isn't put under control, fees across the board will go up. Your $4, coffee is going to be $5 because Starbucks, is going to have to pay someone $20 to make it because they can't hire them at $15 anymore. So, the notion that inflation is kind of isolated to lumber and a couple of these things, no, it spreads. And when it spreads, it starts to spread like wildfire. Why is that important from an investment standpoint? Well, if you believe inflation is here to stay and you believe that it's going to be a while to catch up with inflation, then hard assets is where money belongs. Because when things go up, hard assets go up with it. And so what you're going to have is things like real estate. Again, I don't have a crystal ball. And if I did, I'd be too scared to look into it. But, from a real estate standpoint, I read an article last week and it said for the first time ever, building a new house could result in negative equity. And, there was some, the way they kind of comprised it. But the moral of the story was typically if you bought new construction, when you bought it, you don't close for a 6 or 8 month period. And as a general rule, even though you're paying slightly more to build it than you could to buy it per square foot, even if you do upgrades, the appreciation that accumulates over that period of time usually offsets it. And generally, it's been a break even or better environment for the history of new homes. In certain markets now, because of lumber and labor and all of these shortages, they're actually saying that for the first time ever on record, you could be upside down. Now, for some people, it doesn't matter. It's their home. Being upside down 20 grand to have it exactly the way they want doesn't matter. They don't have to think of it the way that investors do. But what does that mean? Well, it means that if building a new home is rising rapidly in cost, well, what does it mean for my home that already has cheap lumber in it? It's now worth more because for them to replace my house, not only does my land go up in value because of its location and proximity to, the geographic area, but now the value of my house all around me is going up. So in some ways it's great. I think I like just regular good old fashioned cash flow and appreciation. It's why I love, Greg and his business and what they do, because I don't think you have to make 50% per year to be successful. In fact, I think it sends a lot of false, ideology that people are good investors when in fact they're not. And the dust will settle and some of those people will be left holding the bag. But from an inflation standpoint, yeah, if you believe that inflation is here and it's coming and it's going to stay and it's going to spread, then yeah, hard assets all day, every day.
I love this. I love this is a great way to end this because it ties in rental properties with the value of investing in hard assets. And it even ties in those folks that are thinking about taking money out of the stock market and putting it into those hard assets, right? If you are that type of a person who is looking at what is inflation going to do to my portfolio and you have money in the stock market right now, Jason is saying people generally want to go to hard assets because over time, as the cost of goods and services around hard assets go up, so do rent prices, so do home prices over time. That's why we call real estate a hedge against inflation. If you generally know that inflation, over history is known to go up, call it around 3%. Well, if you look over the long time with home prices as well, they generally have gone up about 3% a year. Same thing with rents, right? So that's what we call a hedge against inflation. You don't have that same hedge against inflation in paper assets like the stock market. And so if you are of that mindset that you think inflation is here, and that it's real and it's going to be prolonged, and you want to get into hard assets and you're in your retirement accounts, you need to go and talk to somebody like Jason's team to be able to do that. You're not going to be able to do that through your Schwabs, your Fidelities, because they don't allow you generally to invest in hard assets with your retirement account dollars. And one thing I'll add to that as well, right? For those of us who think that inflation is here to stay and that it's going to be it is going to be a factor in the future. To what degree, everybody has a different opinion. It's going to be here though. More than just investing in hard assets, investing in hard assets that also have fixed debt costs. So taking out leverage on those assets and having fixed debt costs, that's how you like supersize the win against inflation, because you get the hard assets, which generally rent prices and home prices tend to go up. That's that hedge against inflation. But when you take out debt, that stays fixed. And as inflation happens and the value of your income, the dollars you earn actually go up, whether or not it's real dollars, the dollars go up. It gets easier for you to pay that fixed rate of debt down. So that's like the on steroids, how to beat inflation.
Yeah. Oh, yeah.
Hard assets, take out smart debt, and you're going to win in the long run.
Phenomenal call today, gentlemen. We have really, really good feedback from the chat. Everybody was really, really engaged. The community was on fire today with really, really great questions. We had great attendance. Middle of a Tuesday. Never goes moot point on us that you take an hour of your time to hang out. We're here with us today. If you like what you heard, right, the next move is you go to chatwithjwb.com. Contextualize it to your situation, whether it is a self-directed IRA, whether it's not. If you have other clarifying questions of how to make that happen, that's what that call is designed for, is just to really understand your situation and talk you through whatever options you're going to have. Jason, how do people get a hold of you if they want to get a hold of you, man?
Yeah, easiest way is NuViewTrust.com, spelled with a U, NuView Trust.com. You can email me directly at jason@NuViewTrust.com. Yeah, love scenarios, love your questions. I really appreciate the engagement today. Love that we sprinted, love that we crawled, and love that we jogged along the way. And so hopefully everybody got a nugget or two out of today. And if there's anything that's more personal that you weren't comfortable asking in the chat window, yeah, shoot it over to jason@NuViewTrust.com and we can chat.
Great. I put that in the chat. I hope that if you were with us today for the first time, join our Facebook group, jwbfacebookgroup.com, where we hang around there throughout the week. Greg goes live. I don't know, Jason, I think you're a part of that group, no? Or
I am.
Yeah. So Jason's in there also, right? That's just where we keep the conversation going. Join us on Thursday when we do the JWB Rental Income Property of the Week. And we break down one property for you and take your questions, just like today with GC answering it. Jason, I want to thank you, man. This was great. Thank you for hopping in and joining us again. You're a repeat guest. That's not an honor we bestow to many, but you deserve it, and you'll be back. Greg, I'll give you the last word, man.
Thank you, Pablo. And Greg, good to see you, man. Thanks, guys.
Great to see you, buddy. We'll talk soon, man. Thank you again.
All right. Take care.